Hi, and welcome to another presentation from Your Business Tutor, learning your way, anytime, anywhere. If you want to get big in business, then you have one option: become a public limited company. And that's what today's presentation is all about. So what are we going to learn in today's presentation? Well, first of all, we're going to find out what a public limited company is. After that, we're then going to identify the advantages and the disadvantages of being a public limited company. So what is a public limited company? A public limited company is an organisation which is owned and financed by shareholders and which is run and managed by directors. A public limited company, also abbreviated to PLC, is also in the private sector and includes organisations such as the Lloyds Banking Group PLC, EasyJet PLC and Tesco Group PLC. But what also makes a company public limited is the way that shares are dealt with in these organisations, in so much that shares are bought and sold freely on a public exchange. And in the UK, that public exchange is located in London and is called the Financial Times Stock Exchange. And on that exchange, millions, if not billions of shares are bought and sold every single day. So what are the advantages of being a public limited company? Well, first of all, there's limited liability. And as we know, that means that as a shareholder, there's a limit upon how much you can lose if the business becomes bankrupt. So for example, if you only invested £1 in a company, then that's the most you can lose. Whereas if you invested £1 million, then that's the most that shareholder could lose. Probably the biggest advantage, however, of being a public limited company is their access to finance. Because there's no restriction on how many shares can be sold, this means that a public limited company can sell thousands, millions of shares to shareholders, which therefore means they can raise lots and lots of equity to get the business started. So a final advantage is that public limited companies are managed by professional directors. Directors who have vast experience, who have fantastic qualifications, who have a proven track record of driving businesses forward and being successful. So what are the disadvantages of being a public limited company? Probably one of the major ones is the legal requirements around setting up a public limited company. As with a private limited company, a PLC has to have a certificate of incorporation, a memorandum of association, and has to detail its rules and regulations in its articles of association. But in addition to that, and especially when it's setting up, it also has to provide a detailed prospectus to potential investors or potential shareholders in the business, detailing everything that's going to happen in the business. Furthermore, a PLC must provide detailed financial information in an annual general statement. Within that annual general statement, a PLC has to detail what profit it's made during a year, how much the business is worth, what the share value was during the year, as well as what its cash position was, what assets it holds, what liabilities it has, and also has to include what pay it's given to its directors. Moreover, this annual general statement, as well as other issues of concern to shareholders, will be discussed at the PLC's annual general meeting. Now, this is a meeting which must be held every single year to discuss issues of concern to shareholders. So as we can see, the legal requirements for a PLC are far greater than they are for a private limited company. Another potential disadvantage of being a public limited company is the threat of takeover. Because there are no restrictions on the shares, which means they can be bought and sold freely, that means that if there's a company out there that wants to take you over, and they're willing to offer enough money to shareholders to buy those shares, then your business could be bought out, could be taken over. The third disadvantage of being a public limited company is that shareholders will expect dividends. Shareholders invest in PLCs because they expect the company to grow and to be profitable, and they expect a return on their money. And if they don't get a return on the money, if they don't receive a dividend, then they will more than likely sell their shares, which of course could cause the share price of the PLC to fall, which would therefore potentially open up the PLC to a takeover bid from another company. And another disadvantage of being a public limited company is that they take time to get set up. Unlike a sole trader or a partnership that can get set up in a number of days, it would take a public limited company probably a number of months before it got set up and ready for trading. And that's because of the significant legal documentation that has to be registered before the company can actually begin. So what did we learn in today's presentation? Well, first of all, we found out what a public limited company was. And after that, we identified the advantages and the disadvantages of being a public limited company. So I'm sure you can work out from today's presentation that if you want to be a large organisation, you only really have one option, and that is to become a public limited company. And that's because a public limited company can raise significant finance by selling lots and lots of shares on a public stock exchange.